Michael Burry forecasts the collapse of America. Hyperinflation is the culprit. Michael Burry, who became a household name after his winning bets against the mortgage crisis, was featured in the film The Big Short. Since then, this fame has skyrocketed to levels unseen before. From locking horns with the biggest forces to being a guiding light to the novice investors, today he's reigning in the Wall Street hard with a multi-million-dollar portfolio. Welcome back to Investor Secrets. In today's video, we're going to talk all about how Michael Burry is predicting the downfall of America. But before we get started, subscribe to our channel and hit the bell icon to never miss a video from us. That said, let's begin with the video. Michael Burry has been shouting warning after the rampant speculation and excessive valuations in the financial market. Most notably, in the month of February, he had stated that the stock market was, quote, dancing on a knife's edge, and slammed stock trading app Robinhood as a dangerous casino. However, it was not until his dire warnings about upcoming hyperinflation, comparing the United States to the Weimar Republic, officials really began to grow concerned. According to several reports, Burry was visited by the SEC officials who supposedly had warned him about his behavior on Twitter and how it was all influencing the market. The last tweets before the profile was deleted are quite interesting and open a portal into the mind of a man well known to predict several market downfalls. On February 20th, 2021, Burry's tweet can be seen here linking a book called The Dying of Money. Burry suggests that the US government is inviting inflation with their new insane monetary policy. Since the beginning of the pandemic, the US Federal Reserve has been on a printing spree, creating more dollars out of thin air in the last 13 months than in any other period in the US history. With 3 stimulus checks sent out to common Americans and a potential 4th on the table, the implications of money printing are starting to be felt. This is also combined with pent-up demand and growing debt to GDP ratio that makes for a rather American economy. Sure, things look okay right now, but if you know the history, then you can see what's hidden beneath these murky waters. Everything that we're seeing right now points to a severe inflation crisis. Yet the government is claiming that inflation remains a low 2%. This reported rate is starting to become laughable. Look around and investigate the prices. Gas, houses, groceries, cars, the list just goes on and on. All of these items have seen a significant price increase in the last year alone. The Fed chair, well, he claims it's all temporary, repeating this phrase over and over, burning it into the brain of every listener, and how much inflation is the Fed willing to tolerate before it acts to restrain price pressures. On inflation, there are a couple of things that are worth mentioning. Firstly, we know that we measure inflation on a trailing 12-month basis, and as we lap the very low inflation readings of March and April of last year, we will see a measured 12-month inflation move up a few tenths. This is just they're calling base effects, and that's a transient thing that we think will pass. There's also the possibility, indeed, it's in some forecasts, that the economy fully reopens and there will be a burst of spending, and that's because people will be enthusiastic that the pandemic is potentially over. That could also then create some upward pressure on inflation. We would see that as something likely to be transient and not to be very large. In both cases, we don't see those either lasting or particularly large. Eventually, things are just going to become very obvious. The Feds will ultimately be forced to admit inflation, and the results of that will begin to ultimately spiral. This brings us to the second Burry tweet of the day, which is a reminder that the inflation cycle is not going to come all at once. Germany ran not for 1 year, but 9 years, and last year was a complete collapse. This graph puts that tweet into perspective. This is the value of 1 ounce of gold compared to 1 German mark in the time period of 1918 to 1923. During these years, the German mark suffered serious inflation. The German mark is useless and had suffered a complete collapse good enough to be used as toilet paper. But remember that the buildup lasted years. Sure, 1923 was a long time ago in our minds, but the United States is not free from this scenario. As crazy as it sounds, hyperinflation is well known as the #1 way empires get brought down, and this empire is no exception. Based on the events of last year, we have set the primer now, and all that's left is a catalyst to bring it all down. What could that catalyst be? The generous dollar printing we're seeing right now is pumping money into stock markets, and Burry is quick to realize this. His last tweet the next day, on February 21st, states that professional investment teams are taking bigger and bigger risks, and are getting creative to engineer extremely leveraged positions. It's almost like he called what was about to happen next, because this developing story is causing ripple effects throughout the markets. Archegos Capital Management is a family office that had amassed huge positions in media stocks and China internet names. When some of those positions moved against it, and we saw that happen last week, we talked about that in a second. Why was the firm hit with huge margin calls and was forced to liquidate more than $20 billion in stocks? At the center of all this is Bill Huang. He's the founder of that firm, which was set up as a family office after his own was closed. He was a part of Tiger Asia. He's a protege disciple, if you will, of Julian Robertson. In 2012, he pleaded guilty to wire fraud on behalf of Tiger Asia. Now, all of this seemed to unravel late in the week when Goldman Sachs, which for many years had refused to do business with Bill Huang because of those insider trading and not just allegations. But the guilty plea itself had pushed him to sell some of these stocks. He had been leveraged for long in a very big way, especially when it came to stocks like Viacom and Baidu. Now, Viacom, as we saw last week, was hit hard in part because it issued that stock midweek. And frankly, Archegos Capital 1 month later would implode in the middle of a bull market for a firm that managed over in the capital. According to reports, losses may have topped $50 billion due to the extreme leverage. If you read into the details, you can quickly see that this situation was created via complicated financial engineering. The fact that Archegos' positions were derivatives rather than actual stocks allowed it to buy large stakes. Some of them give it exposure to over 10% of these companies' shares without having to disclose those stakes to regulators, which is something they would have had to do with regular stock positions of that magnitude. This allowed Archegos' exposure to those shares to remain anonymous until the trades blew up. This blow-up is one more sign of just how much leverage has been built up during this market mania, and how exposed investment banks are to this leverage. If the times are good and massive investment banks are losing billions and going bankrupt, what will happen when we get a sudden and unexpected downturn? The Archegos Capital story was passed over in one day, but it's a lesson and an event that should be looked into further. If a professional investment team can lose $50 billion during a massive bull run, then what is there out in the waters hidden beneath the surface ready to implode the entire market once things go bad? Massive derivative positions are being built as we speak, and that catalyst that we alluded to earlier is right in front of our eyes. How long before the house of cards falls? If you guys enjoyed this video or think it was valuable, then don't forget to hit the thumbs up, subscribe to our channel, and hit the bell icon to get notified first. Also, feel free to let us know your thoughts about the next video in the comments section down below. See you soon. Bye.